Have I ever dealt with any variable universal life? And what are my thoughts? I have. I used to own a variable universal life policy. It did okay. It wasn't terrible. But at the same time, I'm not a big fan of them because the fees are higher than if you just invested in the stock market. You're paying for life insurance and you're paying higher fees to be in whatever funds that they're in. You're also dealing with life insurance agents. Now, these are people who have gone through and got their securities license. But more often than not, they're not professionals in the securities field. So the illustrations I've seen lately from people doing variable life policies, it's like spray and pray with what they're putting people into. It's like there's 100 different indexes you can choose from, and they're putting 1% in every single one of them so that they don't have to worry about your policy. It's not designed with any sort of focus in mind. It's not taking into account what types of markets we're facing right now. It's just throwing it in a whole bunch of stuff so that some of the stuff's going to go up sometimes, some of the other, and you're just going to get the average. So I'm not a big fan of that. And why should you pay extra for that? I mean, in that case, I would rather get a term policy and just invest in the market if you wanted to be exposed to the market. Or even better, I would go with an index universal life policy where you get guarantees, because in the variable one, there's no guarantees that it's not going to drop. You get zero guarantees that it's not going to drop. If the market goes down, your account goes down. My wife's grandparents, took their retirement money and were sold on one of those variable universal life policies. They thought they had enough money to last the rest of their life. This was right before 2008. They got talked into putting all of their retirement money into one of those. And then it lost half of its value. And they ran out of money and had to go bankrupt. They did not have enough to live on for the rest of their life because it was a terrible time in their life to be put into that product. That was a terrible decision by that insurance agent to sell them on that product. You don't take somebody that's in retirement and put them and expose them to all the risks in the stock market, knowing that they do not have the time to wait for the market to come back up if it drops. On top of that, you don't put them into a product that costs a lot of extra money too to be exposed to all that risk. It was just a bad decision to begin with. There could probably be a place for it for somebody if they fit the right client. But I don't know who that person is because I don't sell that product. Okay? But I know there's a lot of people that is not a good fit for them. And I just don't even want to touch them. So that's where I come from. That's where I come from on that. I had one. It did okay for me. I bought it when I was really young, though. Right? I bought it when I was young. I funded it for a little while. I stopped funding it like people do, like young people do when you got other things that you want to put your money into. And it carried itself for a long time. It paid for itself for a long time. I had a little tiny bit of cash value I took out of it, and I canceled it. And I ended up opening up some whole life policies. I opened up some IUL policies instead. And I'm glad that I did that. I'm glad that I ended up doing that. What are my thoughts on Lafayette for whole life IBC? So I'm not contracted with Lafayette, so I don't know how to design their policies the best. But the ones that I've seen and the people that I know that sell those tend to design 60-40 type of policies, which I'm not a big fan of. 60-40, 70-30. So I don't know if they offer the ability to design it better. And when I say design it better, I mean like I like liquidity in my policies. I don't like to tie up money. A lot of the people that work with me are real estate investors, stock market investors. They don't want to necessarily tie up their money either. They want it to be available if there's an opportunity. And it's really challenging if you're getting a policy that's designed to tie up your funds, a large chunk of funds, if we're doing a big policy, for a year or more. So I do some very large policies for some people. We do $100,000 a year, $160,000 a year type of policies. These are people that want to have access to that money because what is the the difference between, let's go over the life of the policy. For one, when we design it properly, we're going to get a really good cash value growth. And under the assumptions that we have now, the cash value growth is going to be better than the other designs. Things have to change. Dividend rates have to go up in order for that other type of design to get anywhere close in cash value to what we have now, much less do better than it. Things will have to change drastically. So, I don't worry too much about that, but people don't necessarily want to give up access to $60,000 on the off chance that they might end up with a slightly better return in their life insurance policy over the course of 30 years. When that $60,000 could be the difference between a deal that nets them a 300% return or no deal. So I get people that have to make those kinds of decisions, you know. Now, if you're somebody that just wants to put money in a policy and not worry about it, you're not doing outside investments, it makes a bigger difference, right? It might make a much bigger difference. But for the most part, even if you're going to let it sit in there, we get a lot better cash values. So what I would like to do is I would like to be able to design a Lafayette policy to see how good I can make it. Because I don't want to just go off of the assumption that these other agents are designing it the best that it can be done, and 60-40 or 70-30 is the best it can be done. Because no matter what carrier it is, every carrier I have access to, if I can design it to be higher cash value in the beginning, it ends up better down the road. I haven't seen an illustration yet where it ends up much higher cash value when it's designed with lower cash value the first year, which inevitably gives me, the agent, a lot more commission because the costs are just so much higher in the policy. So, hope that helps. Hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.